All right, guys, we're back for chapter 5, and there's my little buddy. I think that one's a little bit bigger than the last one, um, but something that I'll talk about very briefly before we get into our chapter 5 here in technical analysis is the importance of having a nice setting, where you work. I've over the years had many different trading stations where I've set things up, and this one is a pretty nice one. One of the things that I really like having is a window that I can look out of that's like kind of right to the left of me. I don't like a window right behind the monitor because the light kind of is a little bit distracting. I can get a headache from that a little bit. Windows behind me, I'm not going to be able to see them. So I really like positioning myself kind of like this. There's a hotel in San Francisco that I've traded at a lot that has a really nice kind of like perch where you can kind of set up, and you've got the window right there, and the Bay Bridge, and the Embarcadero, all those. It's just really like a nice view. But finding that spot for you that's nice and quiet and that feels like this is the place where I go to focus on trading is important. If you have a lot of distractions trying to do it in your living room with people walking by or kids or whatever, that's going to be difficult. So finding a good spot is important. All right, so with that said, we're going to get in here to technical analysis, and I want to remind you guys that this is not a strategy. Technical analysis is about pattern recognition. How to trade the patterns is covered in depth in the Warrior Pro classes. So we will be getting into that, but I don't want you to think just because I start reviewing some patterns here that you're like, okay, I'm just going to start trading those patterns, because putting the trading around it is when it is that's when it becomes a strategy. So these patterns that you're going to start to see in some of the chart breakdown that we're going to get into, you'll start to recognize them. You'll be like, okay, those are nice, but they don't work on all stocks. They don't work on all financial instruments. And sometimes of day, some different types of stocks, different price ranges, different floats. There's a lot of variables. So it's when you create the criteria for each one of those variables that you start to put together a strategy. All right. She's on Chipmunk Patrol. Look out, folks. Okay, so chapter 5, and we're going to get into part 1 here, which are chart types and time frames. Again, one of the things that I said early on is that this is a prerequisite to the pro classes. Some of you are like, all right, Ross, let's get on with it. I know what a chart is. So we're going to run through this, fast enough that we don't lose those of you guys that are, coming in with a little experience, but slow enough that those who are at the very beginning of their learning curve, we don't want you guys to slip through the cracks either. So finding that happy medium is important. So the charts that I use are called candlestick charts, and those are, let's see, where's my chart? I'll just pop up my chart. So this right here, this is a candlestick chart. Candlestick charts were developed in the 1700s in Japan to create a supply and demand chart. It's over 300 years, almost 300 years old at this point. Bar charts were developed later, but they didn't gain the popularity of candlestick charts. And line charts really are not very popular. Sometimes you'll see people using a line chart on, the news or something like that, but nobody really uses them for trading. So just to show you the difference here, this is a stock chart. Obviously, I'm going to go to properties, and I can change sorry. I'm going to double click this. So this is a candlestick type. So let me make this a little smaller here. So in a second, I'll explain what each of these candlesticks mean. Yes, get out your notepad if you don't have it already. I've got my notepad here. I'm taking some notes on things that I need to remind myself to go back and do and add and stuff. So let's switch to a bar chart. So that's a bar chart. Looks similar, but different. They're not as popular. I don't use them. Most people don't use them. Let's look at a line chart. This is useless. You can't trade with a line chart. You might see them on CNBC or something like that, or they're showing the tick of a stock while they're talking about it, but you're not going to use that. There's all these different types of charts, but most of them are not used at all. Bar charts, candle charts, and line charts. You hear of some people using these Heikin-Ashi charts, but these are very strange as well. They actually change the candlestick shape significantly. So anyways, I use the candlestick chart. It is the most popular, it is the most commonly used, and that's important. As I talked about at the end of chapter 4, we want to be looking at the same thing other people are looking at. It's how you identify the logical places where stocks will break out of their patterns and do what you expect it to do. If everyone expects a stock is going to do the same thing, it essentially becomes a self-fulfilling prophecy because everyone's expecting the same thing. Therefore, everyone is going to act and make decisions based on what they think is going to happen. So you want to be, if everyone thinks the market's going to drop below a certain point, it starts to get to that point, people are going to sell. They're like, oh, it's a good drop. I better get out. I better, get out. If a stock is going to break out over a certain point, people see that. They're like, okay, it's going to break out. This is the place where I want to buy it. So you have to be looking at the same type of chart as what most people are looking at. And that also includes the time frame. So daily charts right here. So now we're going to start getting into charts. And this right here, D, means daily. So that means each one of these little blips, these little shapes, green and red, and green and red, green, 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 red, red, red. Each one of these actually represents one full day from 9:30 until 4 p.m., regular trading hours. It doesn't include after hours or pre-market trading price action. It is just regular trading from 9:30 to 4 p.m. And that's one full day of time. So again, helpful hint, each candlestick represents one period of time, and that period is going to be based on whichever time frame you have selected. So naturally, as a beginner trader, you may wonder, what time frame should I use? I could use an infinite number of time frames. Should I be using a 14-minute time frame? Should I be using a 67-minute time frame? I would not. You would be probably the only person in the world doing it, and that would be a bad idea. You want to focus on using the same time frames that most traders are using. We all look at daily charts. We look at daily charts because we want to see over the past several weeks and months, what does the chart look like? Now, certainly you could use a weekly chart, and some long-term investors might, but most active day traders would not do that. We would use just a simple daily chart so we can see each day of price action. All right, so that's our daily chart. Now this, what time frame is that? That is a 5-minute chart. Each candlestick in this chart represents 5 minutes of time. Okay, so right here, and again, this is the software that I use. I could, and I might actually just install TC2000 for the heck of it for you guys. It's not all that expensive, but TC2000 is it is good software. I do like it quite a lot. I don't have a layout for it at the moment, but I can make one pretty easily. So I'll just I'll install this. I did have it on one of my other machines. So this chart right here is eSignal, the charts that you're seeing up there, and eSignal charts they're not cheap. So for that reason, I don't necessarily recommend that you get eSignal charts. I think they're probably more money than you need, but you could use them if you want. TC2000 is also good, and many simulators also offer, and live trading platforms like E-Trade and Ameritrade, they have built-in stock charts. But stock charts, to be able to have nice-looking charts that are easy to use, this is a fair amount of development work, honestly. I mean, this isn't something that, Joe Schmo software and, gasoline oil changes and, dine luncheonette is going to be producing. I mean, this is all this company does really is produce charting software. So it's pretty intense. All right, so that's our 5-minute time frame. So we go up here, I could switch this down to a 5-minute chart, or I could just type in 5-minute and click enter. And again, the functionality on different platforms is going to be slightly different in the sense that some might have a button here that you click, whereas others have a drop down as this does. All right, so this is a 5-minute time frame. And now we've got a 1-minute time frame. And this is the shortest time frame that I would use for active trading. Now, some platforms, and that does not include TC2000 as far as I recall, can actually go down to shorter time frames of under a minute. But a 1-minute chart, I can change this to 1 minute right here. Now, every single candle represents 1 minute of time. So let's do a little test here. I would like for you guys to look at your clock, and hopefully if you don't have one up, I'll put mine up right here. So tell me, when is the next candle? How much time is left on this current 5-minute candle? 3 minutes and 50 seconds. 3 minutes, 48, 47, 46, 45, 44, 43. I'm just using this and just knowing that the candle closes at 1:25 p.m. at that 5-minute spot, right? So knowing that it closes at that spot, it gives us the opportunity, if we would like to be able to say, okay, this is, we're looking at the first 5-minute candle to make a new high, or whatever the case is. So this candle's going to close in 3 minutes. So the first 5-minute candle to make a new high is the spot where we're going to be watching. When does this current 1-minute candle close? 8, 7, 6, 5, 4, 3, 2, 1, right there. So 1-minute candles close at the top of each minute. 5-minute candles close at the 5-minute increments, 5, 0, 5, 0. So that's right there, your 1-minute time frame. All right, so we've got daily, 5-minute, and 1-minute time frames, and those are the most popular. So how do you know when the candlestick will close? Well, I think we just answered that pretty well. Almost every platform, and this right here is TD Ameritrade. Once we get into a little bit more of platform analysis, I'll share with you. We'll dive in a little bit more to the platforms. But right now you can see you've got the timestamp up there. So you know that candles close. This one is 1906. So the candle will close at 1907 in 52 seconds. The next 5-minute candle will close in approximately 3 minutes and 52 seconds, right? So we just sort of learn that simple math, and I just go in reverse. Some charts, and eSignal is actually nice in this, they actually do have a countdown timer right here. So that countdown timer is going, exactly right. Instead of you doing the math, it's actually saying how many seconds are left. So that's nice. And it shows the very fact that they made that, actually it appears to be 1 second off, but the very fact that they made that indicates that people are asking that question. How much time is left on this current candle? All right, and I think it's there on the 1 minute as well. Again, though, I could probably take that off because I don't actually use it, and things like that can actually use up a little bit more data if you have that running on every single chart. So you could probably, I don't remember where, but in any case, I could probably remove that if I wanted to just speed up the charts a little bit. Ooh, that was unexpected. All right, so candle. All right, so is everyone clear there on both the time frames and how to know how much time is left on a candle? Yes, okay, good. So let me show you one more thing here. So let's look at, let me pull up a chart here that makes sense. All right, so let's say I want to buy, let's just say, for instance, I want to buy possibly the first candle to make a new high. So this is a interesting drop that's happening right now. This isn't really lined up super well. So let's say, I got to find a different stock. I think because the market's dropping, we're probably going to see a number of things dropping. GNUS is coming up, though. All right, so GNUS is coming up. So the high of the last candle right here is 364. So if I want to buy the first candle to make a new high, I could say my entry is going to be at 364. And when do I buy? I buy the second I see 364 printing because I want to buy for the break of that level. So the high there is 64. This current candle's high is 63. Watching. Now I could take a starter early to anticipate that, but if I'm looking for the first candle to make a new high, my entry is the second that price breaks, or if I'm doing an anticipation type of trade, getting in just before as I'm seeing green on the time and sales. This candle, how much time is left on it? 13 seconds. The high of this current candle appears to be, let's see, 63. So in 4 seconds, 63 is our new entry. All right, now I'm going to need to see 63, first candle to make a new high at 63, break. And then I'm going to be looking for the break of 63 and the pop back up to 65. First 1 minute candle to make a new high. Now, this is not a stock I would be trading because it's not a good setup here. But I'm just giving you the example of if we're looking for the first candle to make a new high, then the entry would have been the second that candle broke over 63. So you can buy both a couple cents underneath it as you're seeing volume coming in. You can also wait for the candle to break that level and get in at 64, 65, a couple cents higher. But you usually want to be in within a few cents of the entry. And so a big part of my trading is looking at the high of the previous candle or the high of this last 5-minute candle, whatever the case may be, asking myself, okay, that's the high of the candle. Therefore, the first candle to make a new high is going to be a break over this level. On the 5-minute chart, this has a little bit of resistance here at 65, which we'll get into a little bit more when we're getting further into this chapter. But on the high, this last one at 64. So, again, I might say 65 looks like a breakout spot for a move back up towards 375, 380. So first candle to make a new high could give me my entry at 62 on the 1 minute, then add at 65 for the 5-minute breakout, and then the target is 70, 75. All right, so that was a quick part 1 of chapter 5. I wanted to make sure we were first on the same page when it comes to what candlesticks are and the time frames that I commonly use. One more thing to add is that you will almost always see me with charts that look like this. This is a news feed, so I can close that out. And usually I have 2 stocks on each monitor. So I have one on the left here showing the 1 minute, the 5-minute, and the daily chart. Those being the 3 most important time frames that 99.9% of day traders use. Some traders use 10-minute charts and 15-minute charts. You'll see some traders that like to use 2-minute charts or 3-minute charts. And sometimes people will do that because they don't want to have 2 charts up. But I honestly think that it's better to use the same thing most people are using, and that would be like this. Again, as I mentioned, if I duplicate this, eSignal does give me the ability, if I would like to see shorter time frames. It's taking a second here for it to duplicate. I'll give that a moment. Let's see. There it goes. Okay. So I'm going to drag this down here like that. So I could do, if I wanted, like a 10-second chart down here or something like that. The thing is, to actually trade off a time frame this fast is quite difficult. I don't think it's necessary. I think you can use just a simple 1 minute and 5-minute chart just like this. And I don't know why those got inverted. This should be the 5-minute. This should be the 1 minute. Okay. Because the 5-minute has the 200 moving average, which we'll talk about. The 1 minute does not. But again, this isn't a feature for most platforms, and it's not something that I think is necessary. So don't do it. You've got 1 minute, 5-minute, and daily. That's what you need. You will sometimes see, as I'm doing a recap, I'll say, well, let's look at the 10-second chart to see how the stock traded at the open. And that is because it helps you as a student visualize the incredible price action that may have happened within that first 1 minute. But I think in practice, using it and looking at it, it's going to be moving so fast that you're going to get overwhelmed. So we can just, for instance, look at this on a 10-second chart. It takes a second to load because there's so many 10-second candles. And so now this shows you this sort of opening range on the 10-second. And you can see the same patterns that we'll talk about for 1-minute charts on a 10-second chart, but they will only be respected really if they are also lining up on the 1 minute, because no one really trades on a 10-second chart that I've ever heard of. All right, so we'll switch that back to 1 minute. We'll jump back here and let's get into chapter 5, part 2, breaking down candlesticks. All right, so chapter 5, part 2, candlestick analysis. Again, this is introduction to technical analysis and common candlestick formations. Active traders rely heavily on stock charts. Stock charts are a form of technical analysis. We're looking for specific chart patterns to find areas of support and resistance. And essentially, this is not a lot different from looking at the clouds and trying to predict the weather. We use stock charts to try to predict, based on what has happened before, what will happen next. That's all it is. And like a good meteorologist, we may be right only 65% of the time, but we can maintain a career on that, which is incredible. So when we see a traditional pattern or a stock that's very strong like this immediately brings back memories of similar patterns that we've seen. Other times where we've seen stocks that made this type of move, and after doing that, they did this or that or whatever. So it's this development of a collective memory of patterns and what those patterns can be a prediction of. Ultimately, technical analysis leaves a lot of room for error, and you can still be profitable as long as you manage your risk well. So I try to use a minimum number of indicators to avoid overcomplicating simple strategies and setups. We will talk about some of my favorite indicators during chapter 5. So, of course, this is a candlestick chart, as you already know, and a candlestick chart is composed of hundreds and hundreds of candlesticks. So what does each candlestick actually mean? Each candlestick shape is telling a story. It's telling us about the price action of that stock during that period of time. And so if we look at a big green candlestick, like this one right here, or like this one right here, what is this telling us? Well, the stock moved up. But you can see that there's a little tiny little kind of upper wick up there. And it doesn't look like there's a lower wick. So this stock opened at this price right here. Open is the bottom of the body. It then squeezed up. It actually hit a high of 350. The very top of the candle wick is the high that occurred during that period of time. This is a 5-minute candle. So in this 5-minute period of time, if we actually took that 5-minute candle and we looked at it on a 1-minute chart, what we would see is 5 1-minute candles that made up that move. So let's actually look at that. 1, 2, 3, 4, 5. Okay, so let's zoom this in even a little bit more. So this is our 5-minute chart, and this is going to be our 1-minute chart. I'll move them so we can see them both pretty well. Okay. Don't worry about some of the other lines. You'll learn about all of those before the end of this class. 1, 2, 3, 4, 5. Those 5 1-minute candles are all inside this one 5-minute candle. All right, so on the 5-minute, you've got one huge green candle. On the 1-minute, you've got 5 green candles. And the top of this candle, which was, as it turns out, the last candle, hit a high of 350 right there at the top before selling off just a little bit and closing at about, looks like, 348. The close was actually 340. All right, so it closed at 340. So the 4 pieces of information that we have for each one of those candles, each one of the 1-minute candles and each of the 5-minute candles, is the open, the low, which happened to also in this case be the open. It didn't go lower. We'd see that the open is right there and it doesn't have a lower candle wick, whereas this one has a lower candle wick, and this one has a lower candle wick, and so does this one. So on those ones, that lower candle wick that we would call it, or sometimes people would call it a shadow, is the low. So we've got the open, which is also the low, open, low. Those are the first 2 pieces. The candle squeezes up, moving up in price. You've got the high, and then you have the close. Those are 4 pieces of information. A line chart only provides 1 piece of information. So this provides 4 times more information for each individual candle than a line chart. And this is important because when we look at these candlesticks are telling us a story. Right here, it's telling us that the stock was very, very strong. It does show that it pulled back just a hair off the high, but a very, very mild pullback before continuing higher. But what does this candlestick tell us? Now, this candlestick is a little interesting because what it has is this long upper candle wick. We would maybe call this a shooting star candle. That's the star, and that's the tail of the star. All right, so a shooting star is a shooting stars shoot down. That's where this expression comes from. This is an indicator of a possible reversal because the topping tail or that upper candle wick shows that although the stock squeezed up, it was not able to hold that level. So this is the 5-minute time frame. So that 5-minute candle began right here, right? Because we have 1, 2, 3, 4, 5. That's the end of the first 5-minute candle. 1, 2, 3, 4, 5 is the second. And so this candle right here, which is this candle on the 5-minute. Remember, this is the 5-minute and this is the 1-minute. This squeezed up, hit a high there about 470 before pulling back to about 4. So it shows a little bit of indecision. Now, as it turns out, the 1 minute is showing that it's kind of based out here. So it's not terribly weak, but it certainly would have been nicer if it had maybe held a little higher and not pulled back quite as much as it did. So candlesticks, both in their individual shape, tell us a story. This candle right here, which I'm going to talk about in a moment, is called a doji. It's also called sometimes a spinning top. It has both a candle wick up high and a candle wick down low and a little bit of a body. Officially a spinning top, this is officially a spinning top because it's got this small body right here. An official doji is usually a little bit more like this, where the open and close are almost at the exact same price. That's actually called a gravestone doji, with the gravestone coming up here and a very, very low wick. So there's some names for these candles, but although I think that it's helpful to learn them, I wouldn't go crazy about it in terms of all of the... let's keep going here, and I'll show you what I think is important for you to know. Now, on a red candle, the only thing that's different is that the open is at the top and the close is at the bottom. And the only way that we can really help easily differentiate whether the open was top or bottom is by the color of the candle. So being able to see the colors of the candle are important. If you're someone that has difficulty seeing colors, you can go in here and you can change your colors to colors that contrast better, so it's easier for you to see. So, even if you're using, white and black or something like that, you could potentially do that in a way that would work. You would just have to, figure out what fits best with your charts and stuff like that. So that would be a little odd to me, but again, I don't want to say if it works for you, you certainly should do it. All right, so 5 important candlestick formations. These are the 5 that I really think it's important for you to understand. The first are hammers and inverted hammers, also called bottoming tails and topping tails. The second, doji candles. The third, long body candles. The fourth, bullish engulfing candles. And the fifth are bearish engulfing candles. All right, so let's get in and start breaking down number 1. Hammers and inverted hammers, also called bottoming tails or topping tails. And topping tails are also sometimes called shooting stars. So a hammer looks like this if it's a little mallet, right? You could picture someone holding that as a little mallet. It's called a hammer because if you have this at the bottom of a sell-off, it's said to be an indicator of hammering out the bottom, finding a low. When you have it at the top of a move up, it's an indicator of a possible reversal, as you can see right here. And so that's why we sometimes call this a bottoming tail at the bottom, a topping tail at the top, or a shooting star. I don't ever use the word inverted hammer, although officially that would be the correct terminology, and you may hear that used maybe by other traders in the room. So hammer candlesticks always occur. Now, I want to be clear here. You will see this shaped candle in many different instances. It's not officially called a hammer candlestick unless it occurs at the bottom of a sell-off. So just because you see this candle, if you see it in the middle of 1 minute price action, I don't know, if you saw it like this right here, I wouldn't call that an inverted hammer. I wouldn't call that a shooting star. Even though it has that shape, part of what makes these candles significant is when they're in the context of occurring at the top or bottom of a move. So a hammer occurs at the bottom of a sell-off. A topping tail or shooting star occurs at the top of a move. When these candles occur during sideways consolidation, they're almost meaningless. I mean, they're not completely meaningless, but they have very little meaning, and we don't typically refer to them in those names because those names are very specific to the context that we're seeing, which is important to know. So at the bottom of a sell-off, a hammer candle indicates the bottom getting hammered out. And the fact that the price dropped during that candlestick period, right? So this is a candle, so it dropped and then came back up. The fact that it came back up shows that buyers rallied to bring the price back up. They bought it up. In the context of a reversal, it could indicate that the stock is beginning to change directions. So this is what a topping tail, shooting star, or inverted hammer would look like. It's in the context of near the top of the move. Now, you could have probably said before this price action happened that this may have been the beginning of a topping tail. That would have been okay. because that was at the high at the time. But then this went higher, saying that no, it wasn't ready to reverse. And then this went all the way up here. That's a very strong topping tail and really very bearish, which is to say not strong, that it came down that much. The beginning of a reversal. In a couple of real charts, 5-minute time frames, this is the bottoming tail right there. The stock sells off. Now this is also a bottoming tail on that candle, but it's not a hammer because the body is so tiny. We would actually call that one the doji because the open and close were almost the same price. It's still an indicator of possible reversal. It's just a slightly different candlestick shape. These two are also hammer or doji candles. This one's more of a spinning top. And then this is a nice hammer right down here at the bottom. So hammering out the base, that's the low. So usually when we see a hammer like that, if you were gonna go long, your stop would be at the bottom. Or if you were gonna go short, your stop would be at the top, all right? So this is a good example of that squeeze and then that pullback. Here's another one. Sell off, hammering out the base, right down there. That's the hammer candle. A small second hammer after the first one, maybe again indicating that although it dipped down, it was able to bounce back up. So starting to show a little bit of strength. Number 2, doji candles. A doji candle is considered a candle of indecision. It is very indecisive in the fact that it opens, it squeezes up, it drops down, and then it closes at about the same price that it opened. So sometimes a doji from a very official standpoint would be an open and close at exactly the same price. But I don't really want to be a stickler. If, what's the difference between, that and one that's just like that? They're so similar that a couple cents higher or lower is not very significant. And when I'm visually looking at the chart and I look at it and I'm like, yeah, that looks like a doji, then, I'm going to treat it as a doji. That's kind of the way I look at it. If it looks like a doji, it's close enough to a doji because people will interpret it in a similar way. So this is a doji candle that occurred at the top of a move. When they occur at the top of the move, they're much more indicative of a possible reversal. Remember that when stocks are going sideways price action just by itself is already indicative of indecision because it's going sideways. So a doji during a period of sideways consolidation is not really that meaningful. It's showing an indecisive candle during an indecisive period. No surprise. So we don't consider it to be a reversal indicator or anything super important. It's really only when they occur at the top of a move, because if a stock has been really, really, really strong and then all of a sudden shows a doji, that may show us that the buyers are pulling back a little bit and sellers are starting to step in. It's the indecisiveness after showing real decisiveness that is a pivot or a possible trigger for a reversal. So here you see a stock moving up, doji at the top, almost picture perfect, and then the next candle is red and pulls back. Here's another one showing a squeeze at the open. Now, interestingly, this is a green doji, and it still went higher, showing that candlesticks they're not proven science. Sometimes they will go higher. This was a big doji at the open. It dropped down. Another doji, first candle to make a new high, pops up, drops down, and it's sort of pivoting off these doji candles. It's kind of neat when you see them like this because it helps you visualize, okay, these are candles I should be watching in terms of where we might see possible reversal. But what happens if the stock does break over 1192? Given that this was a strong indicator of a reversal and it's breaking out anyways, if you were a short seller, you would probably cover your shares right there at about 1190. Maybe you would cover at 12. And if it squeezes up to 1210, you're covering and you're frustrated and it's a loss. If it rips up to 1250, you're getting squeezed out pretty hard. So sometimes when the market is irrational, we can make money because people position based on what they think is going to happen. So when something happens that's unexpected, you can capitalize on that. Short sellers get squeezed, or long traders get faked out and we get a quick flash down, but then that can give an opportunity to do a dip trade or to short it, depending on what your bias is. So as part of the Warrior Pro classes, we will be talking both about long setups and short setups because it's important for you to understand where a short seller would set their stop, because then if you see a short setup and it's a false breakout, that may be the place where you should expect to see short covering. Remember, how do short sellers cover positions? Let's do just a quick refresher on that. There we go. If you're short right here, 100 shares. Okay, in order to cover the short position, you have to press the buy button. The more people pressing the buy button, the higher the imbalance is to the buy side, and the more the stock will go up. So, let's say I'm short this thing, sell. I'm short 1,000 shares. So if I, all of a sudden, I'm like, uh-oh, I got to get out of this thing. It's going higher. I'm going to short 100. Oh my God, it's going higher more. Shorting another 100, or covering more, buying. And I'm just pressing the buy button. And you know who else is pressing the buy button? Momentum traders like me. So thinking about these candles, they can help identify possible areas where based on that price action, based on that pattern, I would say this has a very well-established level of resistance here at 1192. If I was short, I would feel pretty confident in that trade. And as you can see, it failed. And most times it will. But the one time that it doesn't, look out. You might be able to capitalize on that trade going to the upside as short sellers get squeezed out. Here is another example of a almost picture-perfect doji at the low. This was on obviously much more thickly traded, higher-priced stock, but a big sell-off, boom, bounce off the low, back up, all the way back up to here. So initially, you've got the doji at the bottom, then you've got a little pullback pattern, another little pullback pattern as it comes back up almost to the high of day, or actually through the high of day. Number 3, long body candles. In contrast to the indecision of a doji candle, a long body candle shows extreme strength in the market. The long body candle is exactly what we were looking at right here on AMRH. This is a long body candle. This went from $1.50 to $3.50. That's $2 and over almost 200% in one candle. That is a long body candle. We love them, but we also see them going down. So I don't know if this had any really, really big drops here today, but there was a couple bigger, long body candles going down, a couple bigger red ones. That one was a bottoming tail though. All right, so they're signs of extreme strength or weakness depending on whether it's red or green. So again, this is fairly straightforward. I think this one's probably the easiest to understand. A couple of big green candles in a row shows some real bullishness. If you're not already in the stock, it's sometimes, is going to feel like, all right, it's extended. I don't know if I'm going to be able to get an entry. And short sellers might see, oh, this is really extended. It's time to short it. But if we can get a good pullback setup, which we'll talk about a little bit more, then I can still trade after a long body candle. A bullish engulfing candle and the inverse or the opposite, which is a bearish engulfing candle. These are candles that show real strength in the market. So if you have a red candle like this, and then the next candle opens lower and then rips up and closes higher, the green candle fully engulfs the previous red candle, therefore basically negating anything that this meant that was bad. This is so strong. Okay, so here was a tiny little red candle, and this was definitely a bullish engulfing candle. Honestly, it's kind of hard to find good examples of these in intraday trades because we don't typically have candles that gap down like that. This candle here, it closed here and then opened lower. You'll see these more frequently in daily charts where you see gaps, but not as often on intraday charts. It's not one of the most important candlesticks, I suppose, but there's another one. It opened a little lower, and then the green one was much bigger than the previous red one. Whereas a bearish engulfing candle, exactly the opposite, opens higher, closes lower, completely negates any positivity that would have come from that previous green candle. Therefore, something like this, where it opens high and then boom, that's a very, very weak candle to start the day. A bearish engulfing candle at the open like that with high volume, not good at all. I mean, in terms of wanting to be a buyer, that's a very strong message that it's sending to traders that this stock is weak. All right, so let me see where we're at. I think that was our last pattern that we were going to review here. Let's see. And I have, looks like a couple more slides. Okay, so there was another example of a bearish engulfing candle, a little bit of a gap up, and then a drop. Now that may have occurred during a circuit breaker halt because it appears there was a halt here, and so there might have been one here, and then it opened higher and then went red. So that is a scenario where we may see a bearish engulfing candle. Now, candlesticks are only significant on the right financial instruments. So just as an example here, let's pull up Sirius satellite radio. Would this be a stock where candlesticks are particularly relevant? No, they're not. They're really not. This is being traded by, and how many shares of volume does this have today? Siri. 20 million shares of volume. How is that possible? Almost every one of those transactions is going to be an algorithmic high-frequency trading program. They're trading 1 penny, 20,000 shares, $200 each time. They're broker dealers. They don't have to deal with their commission. So they're just, these are the big institutional trading firms out there that are making money just across the spread. So charts, not very significant. Bank of America, very thickly traded, may carry a little more significance here and there. It's a little more active. F for Ford. This one's going to be probably more like Sirius satellite radio, not as significant. And then you have a stock like AMRH, which is one of the leading gappers in the entire market today. And this is a stock that was not being driven, in my opinion, by high-frequency trading algorithms, but by actual retail traders and perhaps a few institutional traders that saw an opportunity here to buy a stock that was very strong. And so here, candlesticks matter a lot. So if technical analysis and candlestick analysis is part of your edge, you need to make sure you're applying it to the right stocks. Sometimes people will say, well, I'm trying to learn candlestick patterns, and I keep looking at ExxonMobil, and I don't know, I'm not seeing the patterns that you talk about. That's not a surprise. This is going to be the type of stock that doesn't really form as many predictable patterns. You've got to be trading and looking at the right stocks. So although I do not want you blindly following me on every trade I take, the chat room is a classroom, essentially. And so every day when class is in session, starting right around 9 a.m. when I do my pre-market analysis, I want you to be in the class watching the stocks I'm watching. There's a reason I'm watching them. They're usually the leading gappers in the entire market. They're the ones that are going to be good examples of doji candles indicating a reversal, shooting star candles indicating reversal, a bullish engulfing or a bearish engulfing candle sending a clear message right out of the gates. Candles that you see on those type of stocks, which I would consider to be the right financial instruments, are going to be much more valid. And again, candlesticks carry the most validity when you have a stock that is moving up or down quickly. When they're range bound, unless they have really high volume from being a big mover already today, the range bound is going to be more difficult to trade. So in order to make sure that the candlesticks that we're looking at and that the patterns that we're seeing are valid, we need high relative volume. The high relative volume indicates that many traders are actively watching the stock and that the patterns that will be seen, therefore, are more likely to resolve in a predictable manner. We look for 1, above average volume, and 2, a strong trend. All right. So I hope that makes sense. And as a quick reminder, 2 things. Number 1, candlesticks on very low volume stocks, just the same as a high volume stock like Sirius Satellite Radio. No one's trading this. No one's looking at it. These are unpredictable. These are not patterns that you can rely on. And candlestick patterns in sideways consolidation. Again, sideways consolidation is already indecisive. It's only in the strong trends that these are really significant. If you are feeling overwhelmed, don't be overwhelmed. You'll hear me use the words doji, hammer, inverted hammer, shooting star so many times throughout this class, it's going to start to make sense. It's unlike trying to learn to read music, sheet music, or something like that. We're going to be so actively dialing in these just sort of minuscule little spots on charts to understand the patterns that we're seeing, which candles we're forming, that through repetition, you're going to learn everything that we've so far covered in Chapter 5. All right, so we're going to continue on here with Chapter 5, Part 3, Support and Resistance. Hey, everyone. All right, welcome back to Chapter 5, Part 3. Unfortunately, the first recording of this chapter ended up getting corrupted. The file was corrupt. So this is going to be take 2, which is fine. Sometimes second time around is the best, like with my marriage track record. All right, so today's lesson, number 1 for this section, we're going to talk about support and resistance lines as horizontal and both ascending and descending, and I'm going to show you how to draw them correctly. Now, you can draw trend lines in most trading platforms. I'm going to draw mine, of course, in eSignal, which is the platform that I'm primarily using for my charting. I will say that some platforms are not as solid with their charting, and the fact is, charting, while on the surface it seems simple, to be able to do a lot of complex studies and a lot of drawing and things like that, and to be able to scale all that, it actually is fairly complicated. And so it's not maybe a surprise to me that most brokers don't really have very good charts. And so many of us end up shopping around and using eSignal or TC2000 or something like that for our charts. So Horizontal resistance lines, they're really pretty simple, and they can be drawn on any time frame. 1 minute charts, 5 minute, daily charts. Really, I draw these resistance and support lines based on what I perceive as being resistance or support. And oftentimes a resistance level, once it breaks, then becomes a support level. So they're not just resistance or just support. Often they can actually act as both. And often we will draw a horizontal line at the top of a recent high, helping us acknowledge that that is a resistance level, or at the bottom of a recent low, acknowledging that that's a possible support level. Support and resistance lines can be more valid when they've been tested multiple times without being broken. So like a stock that keeps tapping the same level here, we're going to say, wow, it really has very clear resistance here. If it breaks this level, we should be off to the races. Or it has very clear support down here. However, a stock that just simply hits the high and then pulls back, there is no doubt going to be some psychological resistance as it comes back to that high a day. So if it comes back up here, we would call that a double top and resistance at the high. So drawing them, even if the line has only been touched that one time because it was the high or the low, is still okay. It's also very common to see horizontal support and resistance at half dollars and whole dollars because these are psychological areas of support and resistance. So this is an example right here of a chart where we've got resistance at a kind of random price of 265. The stock hit this level on this day and dropped back down. And then on this day when it started to squeeze up, I looked to the left and up. And the first spot that I saw as possible target or high was this high of 265. So I drew a line. I thought if it can break 265, then we've got a little bit of room to the high of this candle, this candle, this candle. And then really, if it breaks over 3, I'm going to draw a line right there. Because if it breaks over $3, not only is that a psychological whole dollar, it also gives us a little bit of a gap fill setup right here up to the low of this candle. All right, so we'll get into more detail on gap fills and trading these in terms of actual strategy a little bit later on. But just for right now, this horizontal line is drawn at a spot that was tapped twice. So as the stock is coming up on this day, naturally we would look at that as being possibly a resistance point. If it can break above it, prior resistance can become support. This is an example of horizontal support right down here at $1.63. Again, a kind of obscure price, but if that support level is hold for multiple days in a row and been tested several times since holding, then that's the low, that's support, and it is holding. All right, this is an example of resistance at the half dollar right up here. So a horizontal line, unlike my trend line here, or my drawing tool, should be perfectly horizontal. And that's easy to do because, at least in eSignal and in most trading platforms, you manually select that you want to be drawing with a horizontal line and not a trend line that can slope up or down. So right up here, this tool right here is just going to only draw horizontal lines. That's all it can do. It can't do anything other than that. Whereas if I clicked on this button, I can draw, well, I have this set to draw my arrow, but if I click to trend line, then I could actually draw the trend lines, but I have to turn my drawing tool off first. Anyways, here's another example of resistance at the half dollar, 650, psychological, tapped once, twice, 3 times, and actually we have a really good example today that I will pull up here. This was on DGLY, which is not one of my favorite stocks, but it was still a good example. So this kind of late morning, this was consolidating. And it was, first it broke this double top, this flat top, which I thought would be psychological resistance, but it actually broke it without a problem. And then it came up right here to the half dollar. It was just below it at 48. It pulled way back, came back up, tapped 49 on this candle that has a little topping tail, pulled back. And then on this next candle right here, oops, I meant to aim for this one. That candle right there, it broke 450 and actually squeezed up all the way to a high of 485. So a 35-cent breakout off the half dollar, which is awesome. So knowing that when stocks break through resistance levels, they can make really big moves is going to be really important. Here's another one, and this is a really good example of previous resistance. So this line here at 888 was previous resistance. Back here it tapped, here it broke, but then it came up here and here. Usually when it breaks, I kind of don't look at how it behaved before the break. But in this case, I drew it in these two lines, and as I look back, I can see that it was a little resistance there as well. So anyways, this and this is why I drew the line. I connected the two, 88. It broke through that level, came up to 975, then came right back down and bounced off 88 before moving higher. So in other words, previous resistance became support. And that's very common to see. Now, once it's bounced off that level, then from that point forward, I look at it as support based on the action of this candle. But if it actually broke down to here and then came back up, I would say, well, the low of this candle is support. It's no longer, I'm not going to hold the level because of these two candles for now the rest of the day. That would be kind of silly. All right. So ascending support and resistance, ascending and descending support and resistance lines are a little bit different in that we do draw them on the angle. So resistance, and sometimes we'll see channels like this, where stocks are in a descending channel, where it has both support and resistance. Sometimes we'll see that ascending. So a stock will be an ascending channel going up like this. So we can kind of predict where it might hit highs and where it might catch lows based on the previous pops and drops. So this is a perfect example. That right there is descending support. So the line is going down. I connected it basically by drawing two trend lines. And the fact is, I connected right here and right here. If I had connected right here and right here, the trend line might have been slightly lower, just ever so slightly. Now, sometimes it can be hard to know, well, how are most people drawing this? Are they drawing these two? Are they connecting those two? I usually, when I'm looking at the chart, I try to draw it where it looks to me obvious. But it honestly sometimes is a little bit of a guessing game, which is not ideal. I mean, it's one of the reasons I actually would say that I prefer just clean horizontal levels more than ascending and descending. Because with ascending and descending, there's so many variables in how you draw it. One person draws it like this. Another person draws it, like this, touching the bottoms. I generally, when I do draw them, I try to draw them so it's touching the most places as possible. Because if it's touching a lot of places, that means it's probably more valid and more people will also draw the same line and respect it. So that's generally what I say. And in this case, drawing it like that made more sense because then it tested this level down here almost perfectly. And it is oftentimes, it'll be in this area down here where I'm like, oh, well, if this sells off, where's it going to catch support? So I'm drawing the line from starting back here. I'm not drawing it on this day here with a green candle because I don't really care about support until it goes up and then comes back down. But, here with ascending, this might have had a little bit of a level if I connected these two candles right here. And that might have kind of drawn down there and then it broke it a little bit. So then I would have connected it from here to here and then extend all the way out. And then you can see, oh, wow, okay, that's got a lot of validity. So once it becomes obvious, you know that probably other people have drawn in a similar way. This one, a little bit more obscure, testing once and twice. But the reason I drew this is because as an ascending support line, I was trying to visualize pre-market, this was the action. When the bell rings, this might dip down for red to green. And I was trying to guess where might it hold support. So I connected these two lines and it extended out this way. And it actually ended up being almost picture perfect. It bounced off that level, red to green, came up to horizontal resistance up here, which was just under the $0.50. So 350 would be psychological resistance. Then it came back down, bounced off the ascending support line, popped up for a second, broke through it, and then tried to come back up, could not break back above it. So it's really fascinating the level that sometimes, the level of detail that sometimes these stocks trade in with respect to really honoring the support and resistance, both horizontal and ascending, descending. This is a very narrow channel right here, which when you have a really narrow channel, that's kind of not as valid as the one that I showed you before, but it doesn't mean you can't look at it. And then it broke down here. So anyways, I would say that drawing trend lines is not totally necessary. I think a lot of times I can very, very much be visual, that I can visually see that there's support here. If your trading platform doesn't have an easy way to draw trend lines, which is possible, then you may decide you don't do a lot of trend line drawing. But, if you can, and you don't mind subscribing either to eSignal up here or TC2000, which I'll pull up here for just one second. Let's see. Then, you know, it's not a bad idea because, oh gosh, what did I set as my password? Man, I don't remember what I set. Let's see. Oh, here it is. Okay. So this is TC2000, which is the sort of cheaper alternative to eSignal. And if I was going to compare the two, the biggest difference is that eSignal allows you to do basically a tick chart down to 1 second, even if you wanted to, which would be really insane because trying to trade a stock on a 1 second chart, you might as well just stare at the level too. But you can go down to 10 second or 30 seconds, and sometimes it can help you visualize right as the stock is starting to bounce or something like that. But generally, I don't use them for active trading. But TC2000, as of the time of this video right now, the shortest time frame is 1 minute. So, you know, it might be nice if you could, oh, I guess you can do a tick, but that doesn't look right, obviously. So as of right now, the lowest time frame is 1 minute, and, you know, maybe someday they will add shorter 10-second charts. They probably will, but for right now they don't. So CHK here, you know, you can see how, well, those are both on 1 minute, but in any case, they're so similar. So in TC2000, let's see, I'm trying to remember how to get my drawing tools. Edit toolbar. So add a row, and I'm going to say, how do I do this? Let's see, chart data, fundamentals. I thought that I could pop up a toolbar for drawing, drawing tools. Oh, that's right. You embed these on the side. So we put them like right here or something like that. All right, so trend line, just, you know, again, click. It's been so long since I did this. So kind of like this, you can see like that or like that. Horizontal line, H line is going to be like that. So again, it's fairly similar, and you get used to it once you've been practicing for a little bit. All right, so again, I don't want you guys to get overwhelmed. The support and resistance lines, they really are, I think, fairly straightforward. You'll see lots of examples of them, which will help it make more sense. And I think if you are able to draw them, certainly that helps you, but you don't have to. So really, what's going to be more important ultimately will be understanding the important levels on the daily charts, much more than intraday. And on the intraday charts, focusing on the candlestick patterns. So even if all you were able to do was, you know, really quick back out and say, okay, this is my daily chart. What are my levels? Next resistance, 86 bucks. You know, and then, you know, continue to kind of look at some of these highs back here and back here. That gives you a couple of spots to watch. And then from that point forward, it's focusing on the intraday chart, knowing your first resistance is at around 86. This actually came up to a high of 84.75, pretty close to that level. All right, so I hope this has been helpful for you guys, and you can go ahead and continue right on to Chapter 5, Part 4, where we're going to get into the gaps and windows, and I'll explain why I just popped a line right there, right there, right there, and right there. That will make sense after you watch Chapter 5, Part 4. All right, everyone, so we're going to keep going here. Chapter 5, Part 4, Gaps and Windows on Daily Charts. And this is something that used to be exclusively in the Warrior Pro class, and I've added it into the Warrior Starter because I do think it's an important component of technical analysis for you guys to understand at the very beginning of your journey here of learning certainly how to day trade and learning more about technical analysis and trading in general. So we're going to talk about how to identify gaps and windows on a daily chart and how to distinguish between the two. Now, I read charts from right to left. In fact, it is the opposite of how I would typically read a book, where you would read a sentence from the left to the right. It's counterintuitive to read charts from right to left, in the sense that the most recent price action is first, right? And then therefore older price action is farther back. So again, just as a to put my chart up so you can see and visualize this for those that are more visual. Where'd my chart go? Here it is. So let's look at the daily chart. So on the daily chart, this is today, and this is the older price action. So we start with today, and then we look back. So we're starting at the right side of the window and then looking to the left, which makes sense once you have looked at charts a little bit. So for instance, and just to finish this sentence, in fact, it's so important that recent price action can negate the technical levels of older price action. So again, on this stock chart right here, we may have said, oh, this had some significant resistance level, which maybe was, I don't know, like right here, all right? It happens to be around where it is right now. But let's just say, if this stock squeezed up and moved higher, this level is sort of no longer valid. People are no longer looking at it. As it is the case right now, this level is valid because the stock is coming back down to bounce off of it. But if it breaks through it, then it will no longer be valid. So if, for instance, 3 months ago, a stock had resistance at $10, but it's now trading between 12 and 14, so previously at 10, and now up at 12 or 14 up here, this previous resistance at 10 is no longer significant. We would instead focus on the resistance up here around 12 and the support around, or 14 and the support around 12 being the more recent price action. So I look from right to left to look for nearby levels of support or resistance. So we read candles and charts from most recent to historical, from right to left, looking for nearby levels of support or resistance. You cannot skip candles. I'm going to explain what that means. A large candle will block any price action that came before it. Now this is why this was previously in the Warrior Pro class and not in the Starter, because it can get a little bit confusing here. So AMRH, this is the one that we traded today. So let me find a good example of skipping price action. It's not obvious on every stock chart, but I think this one's going to be actually a good one. All right, so I'm going to get rid of all these lines, and we're going to start over from scratch, and I'm going to draw them out for you. Okay, so it looks like I've got one more up there. Oop, and one more right there. And one more right there. Okay. All right, so this was the day that it was gapping up right here. So this day, let's pretend this day hasn't happened yet. All right, but we know pre-market the stock is already at $8. So we already know it's right here. So as I look at the chart, I'm looking left and over. This, well, we're already above it. So the only context I would be looking at this is if I was thinking this was going to sell off and maybe bounce off support before popping higher. So generally, I'm going to look to the left and I'm going to look up. So I got to go to the left until I catch my first line. So it looks like I'm catching something right about here. So I sometimes will use blue lines for daily and orange for intraday, but sometimes if I don't have time, I'll just real quick draw it because I have to manually select it there. So, and let me just turn this drawing tool off for 1 second. All right, so back to the trend line and right there. So that's 744. Okay, so I would say that right there is a significant area. What I wouldn't do is I wouldn't say that this area right here, this candle, that right there, if I drew that trend line and you drew that for me and you're like, Ross, is 729 a critical level? I would tell you the same thing that my math teacher told me, which is that you lack a critical understanding of what I'm talking about. And I don't care if you're 12 years old, you're a fool. You're never going to amount to anything in life. And no, like I don't care about that. So what, he said that. Like I don't still think about that at all. So anyways, $6.29. So skipping over that candle, what you've done is you've skipped over this red candle right here. You've jumped over it. This price action was negated by this red candle. So essentially, the way I look at this is from this point forward, from this candle forward, everything down here is essentially gone. It's gone. It's like an eraser. I don't even look at it. I'm looking now looking to the left and looking up for the next level. Now that's because, of course, I'm looking at stocks as they're squeezing up. Now, if I was looking at stocks as they were squeezing down, I still wouldn't skip over that, but I would be looking to the left and I would look down. So, if I'm looking down here, I would say, well, was there another level down here, down here? You can't go in here because then what you're doing is you're skipping basically over this candle. So think of it as this candle essentially casts a shadow behind it that goes like that. All right, and then candles just constantly cast a shadow behind themselves. So we only look up. So now I'm looking up. So technically, as I zoom in here and make this a little bit bigger, this right here would be the next candle that is somewhat significant. I would say this is not especially significant because this was the top of a big candle, as you can see here. This is just a small little blip, but I could draw it. I could go ahead and draw it right there, 750. So now I'm not going to draw a line at the top of this red candle right here because the previous green one is above it. So essentially what we've done is we've said all of these candles mean nothing until the top of this green candle. But all the candles before that green candle actually mean nothing. So if I was going to draw these in a way that perhaps would be a little bit more clear, I could do this. Let me go in and just show you. And I don't do this for a reason that I'll explain in a moment, but I want to make sure that we all really fully understand these charts. So let me go in here. I'm going to delete this, delete this, delete this, and delete this. All right, and actually, I'll keep this. So I'm going to change this from infinite to extend right. Okay, and I'm going to save as blue, extend right. Save. Okay, so the reason I did that is so I can show you basically that from that point forward, it's from that point forward, the top of that candle. So the reason I think it is helpful to have it go across is because it's easier to spot where the next one touches. But ultimately, these are the levels that are in play. The high of this candle, the high of this candle, the high of this candle. So we don't care about this candle here. We don't care about this green one. We care about this one. Left and up. This one. Left and up. Here. And here. And here. And here. And we can keep doing this until we run out of space. I mean, you can keep going left and up. And left and up. Now, this is only valid and significant on stocks that are gapping. This actually, the bottom there, I can mark. That's a small, tiny little gap fill right here. So I can keep going up to there, and I can stop there. That's probably fine, right? So we jump here. Well, actually, it went through that level. So now we've got to go back even further. So what's the next level up past that? So the next level up is this candle here. And then we actually have gap fill all the way up to here. So basically, what I would say based on this theory, and this is what I've been using for a long time in my trading, is that all of this price action has basically been erased by these candles. The only thing I would say is that as it's coming down here, while it's coming down, and I'll just switch this to an orange line to be different, as it's coming down here, you might say, where is nearby support? And you could say it's here, it's here, and down here, and down here, and down here, and there, and down here. Because those are support levels as it's coming down, looking left and down. So we can look right and up, and left and down. So stocks basically cast a shadow directly behind them from their top and their bottom. And so as candles move up, that range gets bigger and bigger. So when we're over here on this side, as we're watching a stock, I would draw these out in the morning, and then I would say, okay, these are my levels that are in play. These are my support and resistance levels. Some of these are going to be more valid than others, but this is an example of a stock that I think looks really good in a lot of ways, and obviously made a really big move, because you can see that it has these very clear levels in play. Now, these orange lines, see how they now cut through this price action? That doesn't work. These lines, they were valid back here. And then once this came up, they were still valid. But once it dropped back below it, they lose their validity. Because again, the shadow of these candles made everything in this area invalid. So I'm going to manually remove. So is this, if we zoom in on this, just to make sure, again, that we're all on the same page. The day that this dropped right here, this support line from right here, no longer valid. It's gone. Delete it. Right here, the day it broke this level, that support line, no longer valid. Delete it. This support level down here broke on that day, no longer valid. Delete it. Now, it does look like there was a support level right here that ties back to that candle that I didn't draw. So that one stays valid. It held. We come back up. Okay, it's still valid, still valid. Oh, and this actually shows you that it was very valid. It held here, here, and here. But then it broke there. And at that point, it was no longer valid. Gone. This one, broken, there, gone. This one broken there, gone. This one broken there, gone. So those are support levels that are now gone. You could draw, of course, new support levels here moving forward and here when you were trying to predict where it would find support in this area, but then those ones up here would have been invalid. Now, as it comes back up, it's coming back down, you'd say, okay, that's a valid line, that's a valid line, and this is a valid one. It came down to here, so that one's no longer good. So that's the new support level. So we can keep doing that, but I don't usually draw them going down because I'm not shorting stocks, and I'm not usually trying to catch stocks that are selling off on the daily chart. And if the price action has broken it, then the line is gone. It's not going to be a support or a resistance level because it has been broken. What will be in play will be the top and the bottom of that previous candle. So these lines, all those back there, are now gone because this candle broke through all of them. The only one that's still there is this one up here. And now these new ones right here, 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 and here. So I can switch this to a 5-minute chart, ABIO. And then what we could look at is we could actually see on the day that it was squeezing up how it behaved around these levels. So this is some deep technical analysis type of stuff. And you can see there were a lot of resistance levels here, and sometimes stocks like this one just blew through these levels. So this one didn't really respond well to those levels. It did tap this to the penny right there. That was $13.48, right around $0.50. Then it pulled back, came back up to this level. And again, once these levels have been broken intraday, I kind of start removing them because I'm like, yeah, these have now been broken. It's coming back down to them. Maybe you could leave them on, but I sort of feel like once they've been broken, that casts a shadow. That's the beginning of the daily shadow being cast back behind it. Comes back up here, and these ones weren't really super significant. And they were really far back. So to answer that question of how far back do I look on charts, I'll go back until I see something. And if that means I'm going back 2 years, I'm going back 2 years. If I'm really trying to see where there is some level of resistance, then I might as well keep going back. So I am hopeful that many of you are still with me, although it wouldn't surprise me if there's a few that are starting to feel a little bit like, wait a second, we just got into the deep end. So it's okay because we're going to keep going through this. Just like everything else, we're going to repeat this a lot. And so it's going to become second nature, even if it's a little fuzzy to start. And again, we can start just by looking at each one of these days. So we knew the stock already was a pre-market high of about $8. I looked back and I saw the high of this candle back in September was about $7.44. So I thought, okay, $7.44 is possible resistance. If it breaks $7.44, what's the next level that it might hit? Again, this casts a shadow basically directly behind it. So I'm looking to the next level up, which here was $7.50. Okay, cool, $7.50. All right, $0.50. If it breaks $7.50, what's the next spot? So I go straight back and then I go up and $7.66. Straight back and up. Okay, $7.77. Straight back and up, $8.25. Okay, so this is a little bit of a window here. Remember when I said gaps and windows? This right here is a window. A window is formed by a candlestick. And sometimes you'll hear people call this a gap, but it's not. It's a gap. It's really not a gap because it wasn't formed by the stock gapping down. It was formed by this big candlestick. So this creates essentially what I would call a window of zero resistance from $7.77 up to $8.25. From $8.25, we go over and then up to the top of this candle. We've got room to $8.40. Nice. We break $8.40. So if this stock breaks $8.40, what's the next level? We go left and we go up. $8.88. Okay, nice. So now we're starting to think about what the profit targets might be, where we might see some resistance. And if it breaks this level, what's the next level? Left and up. $9.38. Now it's starting to open up a little bit. And if it breaks $9.38, left and up, we've got $9.69. If it breaks that level, left and up, $10.77. That's a big window. That's a really nice big window on the daily chart with no resistance. Now remember, resistance could come in other forms, which we will talk about as we get into the technical analysis of moving averages. But for right now, let's just keep it simple and say that there's no resistance till 1077. And if it breaks 1077, we go left and up, and that's 10.99. And we go left and up, and that's 12.46. Left and up, 13.48. Left and up, 13.80. Left and up. Now, this one right here, let's move this down a little bit. This is actually the first one of all of these little spots that was created by a gap. So on this day, the stock had a low of 14.03, right? That was the low of that daily candle. And the high was 17.60. So we've got a really nice big window there. But on this day, it closed here, and then it actually gapped lower, opening at 13.80. And so this right here is actually, it's actually a gap on the daily chart. It's actually gap fill. And let me just, if any of you guys can think of a really good example, a recent example of gap fill, give me a shout so I can pull that up as an example. Because this is such a tiny gap. It's not really a very significant one, but the gap is only 13.80 to 14.03. It's only 23 cents, but that is technically a gap. Therefore, I wouldn't call it a window, I would call it a gap. So BBTH and CAPR, let me just pull those up on another monitor. BBTH, CAPR, let's see. I don't see one on BBTH that's really good. CAPR. I don't see a really good one on that one either, actually. I'll maybe pull them up in a second. They were stocks that gapped, but oh yeah, I see that in my camera. I wonder if my battery died. Shouldn't have. Let me just see what's the battery saying? Because I am plugged in here. I think it might have just turned itself off. So anyways, that's fine. So this, again, small gap, I'll show you an example of it in a second. This is a big window, and then again, left and up, that's a big window. So let's look, I'll check some of the examples that you guys mentioned. PHIO. Yes, thank you. Good one. So on this day that it was gapping up right here, we would look at the chart and we would, and you can see it opened at like $5. So I probably wouldn't have been looking at levels at 3 or 4. I would have been looking at this as, okay, it's gapping higher. What are the daily levels? So moving higher. So if we look at this on a 5-minute chart, this is what it looked like pre-market. All right. So this is where I would have been like, okay, it's currently at 620. As it's pulling back here, what are the levels up here around $6.80, $8, $9 that I can look at as being possible resistance points, right? That's what I'm looking for. Where's resistance? So let's go to the daily. Let's go left and over. And we go left. That's 366. Let's switch to our blue line for dailies. The only reason this is helpful is because if I draw the daily here and then switch to the 5-minute, 366, and then all the way up to here. Right about there. So that is a gap. That's a gap on the daily chart. Now originally, the gap was formed right back here. So originally the gap was bigger. It was a gap all the way down to about 340. Okay? Then right here it came up, and right here it started to get into the gap, but only by like a couple cents. And then it went lower. And as it came up on this day, we probably looked at it if it had high volume and said, wow, this has room from 344 all the way up to 666 if it can fill the gap, meaning it has no resistance until it hits that level. But it couldn't get up very much higher, and it hit a high of whatever this was, 66 or so. All right, so I'll leave it at 68, 67. Whoops. All right, there we go. So now that's the level, 66. Right? So this level here, it's not in play because this candle casts that shadow backwards. 66. And boom. So this is the day where we're thinking, all right, gap fill, 666. And it almost hit that to the penny. Now, if it had broken that level, the next spot would have been up here. So gap fill, and then a window. A small little resistance level right here, and then another nice bigger window right there. And again, we could keep going back. We could go left and up to the next one, and so on and so forth. I'm having a little bit of trouble with my drawing tool here. My drawing tool is not very compatible with eSignal. So again, we keep drawing those as we go left and up. All right, so I'll take those off. So good example of gap fill. Now let me show you, let's jump back into the slides where I do have some more examples. Okay, so we're still on this slide. Okay, so we read price action from recent to historical, from right to left. We cannot skip over candles. The large candle will block any previous price action with its shadow. We always look for obvious patterns and obvious support and resistance levels. If it's obvious to you, it's obvious to thousands of other traders. We always look at price action around psychological areas of resistance, half dollars, whole dollars. We look for gaps and windows. A gap or window should be large, meaning it's kind of like 2 times the size of an average candle. Don't worry about the average true range. I really don't look at that. So don't worry about that. Just eyeball it. If it looks bigger than a regular candle, it's worth watching. So that gap on PHIO, that was a really big gap. Therefore, that was one that was, I would say, certainly worth looking at. 66. I mean, that was a big gap, clearly bigger than any candle. This was a bigger gap right here, but this was more of like a smaller gap right there. All right. Gaps can only be formed when a stock opens higher or lower than it closed the previous day. And windows, although they can be another word for a gap, we often use them as the distance between the top and bottom of a very large candle as we're looking left and up. So now let's look at some examples that I've got for you guys. So on this daily chart, I put a little blue box on each of the gaps. Some of these gaps, like right now, as of this day, this gap is valid if it comes back up for gap fill. But this one, the previous price action has cast a shadow back. And this one, obviously the price action has cast a shadow back. So those are no longer valid, but you can see them on a daily chart just so, as I wanted you to be able to identify them. So we've got 1, 2, 3, 4 gaps there on that chart. Gaps are only relevant on daily charts because they really only exist on daily charts unless stocks intraday are getting halted. If they do halt intraday, then gaps are valid on intraday charts. Okay, there's a gap. High, the close of this stock on this day was right here, and the open the next day was right here. So this literally closed at like $20 and opened the next day at 40. That's crazy. But that happens sometimes, and it created a gap on the chart. Here's a couple little gaps on Facebook. A gap down, which eventually within a few days got filled, coming back up. A gap down here, which eventually got also filled, coming back up later, not in this chart. Okay, so here we have one of our windows that we talked about from 877 up to 1960. That's a big window. It's not a gap, but it's a window on the chart because there's no resistance from the high of this candle all the way up to 1950. On this one, I drew in all of the lines for the gaps and windows. So we've got one right here. And then we've got another one right here. And then we've got another one right here and right here and here. So again, going left and up, drawing out these levels. All right, so with that, we have come to the end of Chapter 5, Part 4. Chapter 5, Part 5, we will get into our favorite multi-candlestick chart patterns. So what we're essentially doing is building a foundation, beginning first with understanding the basics of time frames, candlesticks in their individual form, and then building on that with support and resistance levels, then getting into gaps and windows. When we have multiple candles lined up together, that's when we begin to have candlestick patterns. Towards the end of this class, we'll be pulling everything together, showing you multiple candlestick patterns with the context of gaps and support and resistance levels. All right, so this has been we've gotten a good way through Chapter 5. We'll resume this tomorrow, Chapter 5, Part 5, right back here, same time. All right, I'll see you guys then.